Hello and welcome to this second masterclass, Introduction to Options. I'm Devarsh and I'm joined with me, Nandish.
Good evening, friends.
So let's start. So our topic for today is options, but let us just catch up with the derivatives. So as we discussed last time, derivatives are getting popular day by day. They are gaining a lot of significance. They are growing at 36% CAGR for the last 10 years, and the popularity is growing leaps and bounds. Why derivatives are becoming so popular? As we discussed last time, these are the only instruments which help you express your view in any kind of markets, whether markets are bullish, whether markets are bearish, whether markets are sideways. These are the instruments which help you express your views. So derivatives are giving a lot of advantages to their holders. And derivative instruments offer higher leverage, higher liquidity. They also comes with the facility to hedge and manage your risk, and also give you a benefit in terms of lower transaction costs. So because of these distinct advantages, derivatives are gaining significance in Indian market. So as we discussed last time, in Indian equity markets, there are two types of derivatives available: futures and options. Let us just recap what are the futures. So futures is basically a contract, an agreement between two parties whether to buy or sell asset at a certain time at a fixed price. So for example, say I am bullish on a share, so I would like to go long on it. I think that the stock price can go up. So how do I benefit out of derivatives markets? Basically, using options, I can go long on futures. Using derivatives, I can go long on futures. So suppose I'm bullish on Reliance, what I can do, instead of buying in the cash market, I will go and buy Reliance futures. The benefit is that as Reliance prices go up, I will benefit out of the rise in the stock prices. But what is the risk involved? Risk is if prices go down, I'll have to bear the risk of prices falling. So basically, the risk and reward are unlimited in futures. When the futures expire, the difference between my price at which I'm entered and the price at which the last Thursday of the month, I will have to calculate the profit and loss. So futures are the instrument by which you can express your opinion whether on the long side or on the short side. What are the distinct benefit of futures? In cash market, you cannot go short. Suppose you are bearish on a company, suppose you think that the prices of that underlying is overvalued and it is likely to go down. Derivatives, and especially the futures, you can go short and benefit out of it. If you think that the certain stock price is extremely overvalued and it is likely to fall in next 1, 2 or 3 months, you can go short on those futures. The outlook for the underlying is that when you are going short, you are basically thinking that the prices will go down. Your risk is unlimited because once you short, suppose prices keeps on going higher, you will lose that much amount of money. And profit is also unlimited from your price to, suppose the stocks go to zero. Between your price to the zero, whatever the price comes, you benefit out of it. So the futures are the instruments with the help of it, by paying a certain lower margin, you can benefit. Here, compared to cash market, you do not have to pay the full margin, full amount. By paying around 15 to 20% of the amount, you can take the exposure. Futures are also instrument which help you express your bearish view, which is not possible in the cash market. So these are the benefits of futures. Similarly, in Indian derivatives market, options are also very famous and they are also gaining a lot of significance. Nandish, can you please explain what are options?
Yeah, sure. So there are two types of option. One is call option and the second is put option. The call option, it gives the buyer the right, but not the obligation to buy a given quantity at a given price. In the case of put option, it gives the buyer the right, but not to obligation to sell a given quantity of the underlying asset. Now let us understand with the example. Suppose as a trader, you are bullish on Reliance. So now the simplest strategy is to buy the call of Reliance. Now suppose you buy a Reliance 1100 call at 40 rupees. Here, in case of buying a call, the loss is limited to the premium paid. So as the example shows here, your loss is limited to the premium paid, that is 40 rupees per lot. However, your upside is unlimited. So now if Reliance moves up to 1200, 1300, then your profit will increase as the price moves along. However, in the case of if price falls, your premium will be limited to the premium paid. So the main advantage of buying a call is that your risk is limited to the premium paid. Now let's move to the buy put. So now if you are bearish on market or bearish on some stocks, the simplest strategy is to buy a put. Suppose now let's take an example. Suppose you are bearish on Reliance, bearish on TCS, and you are expecting TCS to go down from here. So here you buy TCS 2000 put at 30 rupees. In this case, also your loss is limited to the premium paid, that is 30 rupees in this case. Now if TCS moves down to 1800, 1700, you will earn a profit as the price goes down. Suppose if TCS goes to 1800, your profit will be 2000, that is the strike price, minus the CMB, that is 1800. So 200 rupees per lot. And if you deduct the premium paid, that is 30 rupees here, then your profit will be 170 rupees. So the buying a call, in case of buying a call and in case of buying a put, the risk is limited to the premium paid. Now in case of buying a put, as I mentioned earlier, your risk is limited to the premium paid. Now let's move to the factors that affects the option pricing. There are 5 important factors that affects the option price. Mainly they are stock price, strike price, time to expiration, volatility, and risk-free interest rate. So as this table shows, so if the strike price move up, then your call premium will go up and your put premium will go down. In case of time, higher the time, higher will be the call and put option premium. While in case of volatility also, if the volatility is higher, the call and put premium tends to be higher. Now, so that is the option. That is the I have explained about the call and put option. Now, Devarsh, can you please explain how one can use option to hedge the position in current volatile market?
So the benefit of derivatives is easily understood by the benefit it gives in hedging. For example, we are going through quite volatile market. The Nifty has fallen from 12,400 to almost 8,500 in today's opening session and then settled around 10,000. Yeah, while such a volatility, you cannot hedge in the cash market. In such a scenario, if you use derivatives, you will be able to manage such risk. So, for example, say I am bearish on the market and I have a portfolio of rupees 50 lakh. Now, I do not want to sell this portfolio. It is a long-term portfolio. I want to keep it for many years to come. But I'm worried that this month market may fall. We have seen that markets have fallen quite extensively in month of March. Suppose you were bearish on the market and you wanted to hedge against the fall in the market, and suppose your portfolio size is say rupees 50 lakh. How do you hedge in such a scenario? The simplest strategy in such a scenario is to buy index put option. So for example, let us take Nifty as one of the underlying. So your portfolio is say 50 lakh rupees and you want to hedge the exposure from say Nifty going from 11,000 to and lower. Now, how do I hedge my portfolio? I will go out and buy Nifty 11,000 put options. For the sake of simplicity, let us say the put premium are trading at around 200 rupees. So I will go and acquire Nifty 11,000 put option for rupees 200. So 11,000, from 11,000 my profit and loss will be calculated. I am paying 200 rupees as the cost. So from anything below 10,800, Nifty were to fall anything below 10,800, I will start gaining on that strategy. So I will basically hedge my portfolio. Example, suppose you are owning a portfolio of large cap stocks. These are the stocks which are behaving similar to the Nifty. For the theoretical measure of measuring whether your portfolio moves along with the Nifty or not is called beta. For sake of simplicity, I'm assuming that your portfolio beta is 1. So I'm going to buy equal amount of options, put options. So I'll go out in the market, buy 11,000 Nifty put option. The lot size, as we studied last time, is 75. So I will buy around 6 lots of Nifty put option. So I will pay 75 into 6 into 200. So I will pay 90,000 rupees and buy my insurance. So 90,000 rupees on a 50 lakh rupees is around cost of 1.8%. So by paying this 1.8%, I will hedge my portfolio for that month. In our example, I will hedge my portfolio for month of March. Suppose Nifty were to fall from say 11,000 to 10,000. My portfolio, see in this 9% fall in Nifty, my portfolio will go down by 4.5 lakh rupees, assuming my portfolio behaves like a Nifty. But while hedging, I will also earn 4.5 lakh rupees from my option premiums, and basically my loss will be in the cash market, in the portfolio will be covered by my profits in the options market by buying put options. So as this is the example shows, the derivatives is a great risk management tool. If you apply it judiciously, you can produce good results and benefits. Most importantly, derivatives is an instrument where you are transferring your market risk and using this hedging technique to another speculator who is willing to take that risk. In our example, we are buying put option, and the risk of market falling from 11,000 to 10,000 has been transferred from us to the person who is selling the put option. So using this example, we can see that in a volatile time, one can hedge portfolio and prevent losses. Prevent losses in the losses of underlying. So suppose you are owning a one stock in a large quantity, you can, if that stock is available in the derivatives market, you can prevent losses temporarily by buying put option and help your underlying exposure from going down. You can continue holding your shares for the longer term, but the intermittent risk is taken care of by buying such options. Hedging involves cost. So please understand that suppose you buy put option or suppose you buy hedging, and in that month volatility does not come. If prices actually do not go down and if prices remain at that level, you will end up losing your premium. Just like say car insurance. If you buy a car insurance and if an accident doesn't happen in that year, you will lose that premium which you have paid, because the risk, if it is not materializes, it doesn't yield you any result. This is just an insurance. Same way, by buying Nifty put options, you can hedge your portfolio, buy an insurance that if there is volatility, if there is some accident in the market, and if market falls down precipitously, you will hedge yourself. So hedging is a great tool, and Nifty put options can be used to hedge your portfolio in such volatile times. So please understand these derivatives. Derivatives are a double-edged sword. If you understand them, if you use it to your advantage, it will give you great results. But without understanding, you please do not indulge into derivatives. Go through our masterclass videos, video 1 and video 2, which will help you to understand derivatives in detail. And with the help of these derivatives, you can benefit out of it. If you are a trader, you can use them for speculation. If you are a long-term investors, use these derivatives to protect yourself against market volatility. I hope this example helps you to understand how derivatives can be beneficial in such volatile times. We will come back with you next week with another webinar on how you can use derivatives to benefit and protect yourself. Thank you all for joining, and have a wonderful weekend.
Thank you all.